All right, so let's begin the show. The website that you are browsing, is it safe? Or the e-commerce website that you are shopping from, is it safe? How do you ensure that your personal data that's stored on the website or e-commerce website can't be compromised? How do you ensure that the reward points that you are enjoying are not scammed? Well, I'm talking about a latest scam on these lines. Let's learn more about this. And for that, I have Rahul Tyagi, co-founder Safe Security with me. Rahul, good evening and welcome to the show. So, Rahul, these hacks keep getting interesting, and we've been talking about the similar kind of hacks earlier also, but there is something new where a B2C website is hacked, okay? I just want to understand what's the new case about?
So I think this is not a new scam, but previously, if you see 4 to 5 years ago, the hackers used to exploit the pricing of e-commerce websites. So for example, if they want to purchase something for maybe 400 rupees or 500 rupees, while selecting the 500 rupees, when the request will go to the payment gateway, they will convert that 500 rupees to zero. So that means you'll be able to purchase anything for 0 rupees and the goods will be delivered to you. But the payment gateway do not know that they haven't been received the money. So this was the scam where they used to skip the monitoring part by tampering the payment system. Now in this scam, the person who is in Bangalore, he frauded a website with respect to an fraud of 4.16 crore, where this person's credit card got hacked. He reported to the bank, and then with respect to the resolution, bank gave him some e-commerce redeem vouchers, which is from Reward 360 company. And those vouchers can only be used as a resolution on e-commerce website. So for example, if you lost 5,000 rupees, they will give you vouchers of 5,000 rupees. Now this criminal, what he did is, he understood that bank issues these vouchers from a company known as Reward 360. Now, because he is from the IT background, he tried to hack into Reward 360 and were able to maintain a regular access into that company and create the similar bank vouchers for himself. So he was using to buy those vouchers to buy motorcycles, gold, some jewelry, some e-commerce website like Tanishq and so on and so forth. So anywhere where that voucher can be used, he was using it. And at the end of when he got caught, it was more than 4 crore rupees he has already duped to that website.
All right, so Rahul, the point and concern over here is these are websites, e-commerce related scams. So this raises questions on the website cybersecurity measures also. What according to you could actually damage a user in terms of their data, in terms of their financial information? Because the end user over here is the one who's impacted.
So I think if you see this entire hack, again, as I told you, this is not new. If you recall, there are a lot of websites like Freecharge or some other website which used to got hacked in a similar fashion, where people used to recharge their mobile phones without paying to the company. And that when the scam got discovered, there were a lot of people who got arrested and similar amount, crore or rupees got into that fraud. Now, when it comes to a user, usually these criminals sell the reward points with less amount to the user. So it's usually kind of a benefit for the users. But the problem is that if the company is holding a critical data of users on the similar website, if a criminal will be able to obtain these reward points, that means he has already compromised the entire security of the company. And in that case, he'll be able to dump the data of the customers also. But in this case, the criminal only wanted to redeem the vouchers, but the level of breach the person were able to get into the organization was huge. Now, from a company's point of view, that's the reason our RBI and PCI DSS, all the compliances are very heavy. Now, I was looking at their website. Now, the security is very tight. Not sure if was it the similar security when that hack was taking place, but in normal way, I think for organizations and especially the new startups who are into the similar business, who want to start the similar business, for them, a regular VAPT is basically a process where you hire a third party organization who is a very proficient in terms of auditing, like a hacker. They will try to hack your website in all the mediums, all the faces, and give you the report. It's just like the CA report, Chartered Accountant report, which gives at the end of the quarter or a year. So as per the RBI mandate, that every quarter you have to produce this report and submit to RBI if you are dealing with the financial transactions on the website. So I think what is the learning from all companies from this attack is that you need to ensure that regular VAPT has to take place in your website, and also the developers who are developing this website. Usually we hire the developers who are not having security background, but nowadays the level of coding and what level of financial transactions which are involved into the e-commerce website and the entire ecosystem today, you cannot hire people who do not have a development knowledge without the security protocols inside it. So a very good term which is used in our community is DevSecOps. That means development with the security. So previously money was not involved. That's the reason it was only development. But now organizations who are looking for the developers who are developing these type of websites, they need to hire secure code developers who know how to code, but also who need to code it securely. And also the auditing at the time of building, you need to build it secure. And at the time of auditing, it has to be every quarter so that whenever you find any flaw, you can patch it very quickly.
Right. So, Rahul, a layman or an end user would definitely won't be able to decode all of this, okay? So, say if you're a user of one of these websites and this website is actually hacked. So, what would be your red flags? You know, maybe too good to be true kind of offers or reward points. How do you actually come to know that the website or the e-commerce where you're trading is actually hacked?
See, the funny thing here, Kavita, is that mostly in these type of hacks, so there are two type of hacks. When a criminal wants the users of that website to know that yes, the website got hacked, in that case, you will always see whenever you open the website, the homepage of the website is completely replaced. That means mostly the reputational damage the criminal wants to do to the company. Because today, for example, if you go to Amazon or Flipkart or any website, and suddenly when you entered and it says this website got hacked, now definitely second time when you want to go there, you will be cautious, right? In this particular hack, customer will not be able to find anything, because on the front end of the website, criminal do not want the users to panic, because the more user will go there, more reward points they have to contain, and in the background it will have a kind of a tunnel inside the website which will extract those coupons one by one without giving money to the company. So for a user, usually it's very difficult to see unless and until the website comes to a public domain that this got hacked. Now the reward360.co got into news that this was hacked because the criminal got thing. For how much time this breach was continued, this clarity is not known to the users till now. So that is the problem statement, Kavita, here.
All right, very important thing that users should be noting down. But then, what will the website do in case of damage done to the user? Would they compensate?
So for the user, I think in most of the cases, if the user's identity has been compromised or something, mostly the companies will give them some compensation. So it has to be given by the company to the users. Unless and until it is not happened, if it is the only hit to the company's data, then users has nothing to do with it. But in case the company is breached, users data has been affected, then the company will notify the user, and whatever the compensation will happen, they have to do it. And especially with respect to the new data privacy law, if anything this type of thing will happen again, now there is a very big penalty on the company. Along with that, the compensation needs to be given to the users.
Rahul, one more very important question is, with so many players coming up, how can one ensure that the developing measures that you also just mentioned are taken care of? You know, a layman definitely will not understand whether the website or the e-commerce website is taking care of all these things, all the nitty-gritties, maybe, you know, informing up a website. Who is actually checking the cyber hygiene over here on all these platforms? RBI as a regulator has definitely given a lot of mandate, but then is it actually in place where exactly it's supposed to be?
So I think RBI is playing a very important role in that. I'll just give an example. Whenever there was a time when we ordered the Bhim application when it was launching, right, and some other payment like Xiaomi or other GP and all. So at that time, you know, RBI has mandated whenever you are publishing any website, you have to give a report on the security of that application without it before it goes to the users. So that is point number one. That is mandatory in every company in India who is dealing with financial transactions. Second, every 3 months, that means every quarter, you have to hire a third party who is independent body, any security company, who will come to your organization or who will try to hack your website, test the global standards of the security, and give a report to your organization. Now, I want to clarify one this thing here, that I think in this case of example, maybe they have hired only one company. That's the reason the flow left missing. Usually the bigger organization hire one, two, three, maybe five companies who are simultaneously testing their website. And then once they submit the report, the company will collect those report, make a single report and submit to the Reserve Bank of India. Now, people usually try to save bucks, and they will say that, okay, let's only one company, but one company will be having number of employees, and the scale of your application can it like very big. For example, someone wants to test the security of Facebook or maybe Google. You cannot do it with the 20 people who sitting in just in one room, right? You need to have more people and have different eyes and different styles, and that's why number of these type of companies needs to be onboarded, who will do this testing every quarter. You collect all the five reports, compare with it, whatever the loopholes they have given to you, you fix it, and then you submit to the RBI. So number one, RBI definitely has given a lot of things to secure this. And second, the audit people, audit clarity and audit frequency has to be increased, along with the number of people and number of organizations who will be doing the auditing at the similar time every quarter.
All right. So in the end, Rahul, till all that happens, all the users have to do is just be cautious.
Users absolutely needs to be very cautious, and that's the reason usually we say that do not trust easily on the new websites who are coming. Again, this is not against any startup, but you usually say whenever you visit any website, there is always a logo under the website which says PCI DSS certified. Now that means is that it is certified by the payment card industry, which is a global standard. And usually if anything, and the last thing which I just want to share, that usually on these e-commerce websites, they are using sometimes they are using their internal payment gateways. Now if it is a new website using their own payment gateways, I am not going to trust mostly on that. I want that the new website, which is e-commerce website, when I click on the payment, it should go to Razor Pay, or it should go to Paytm payments or somewhere else, which is reputed payment gateway server. So if some companies used to do that, if you as a company, if you're not 100% sure that you're going to take care of the payment gateway, do not take risk. Just make sure you attach the payment gateways like Razor Pay, Paytm, and some other who are reputed in the market. And then once you're confident that your programming and your scalability from your security point of view, your internal payment gateway is ready, then you can remove that and plug in your own. But unless and until you're not sure, don't do that. Otherwise, you will fall into this type of scam.
All right, so this is the new scam that Rahul, you have decoded for my viewers. Thank you so much for being on the show, and thank you so much for helping our viewers once again on this matter. On that note, let's take a quick break, but then post that, let's talk about gold in your portfolio and your strategy in fixed income considering the interest rate scenario. I'll be joined by G Chandrashekhar and Lakshmi Iyer after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. So interest rate cycle, equity market volatility, rising crude prices and overall impact on Indian debt market and your exposure in fixed income. Let's discuss all of this today with very special people I have on board. I have G Chandrashekhar, commodity expert, and Lakshmi Iyer, CEO, investment strategy, Kotak Alternate Asset Managers. Good evening and welcome both of you. And all right, so let's take it asset class wise. And Chandrashekhar sir, let's understand the gold trajectory now these days.
Well, I'm sure all of us know about the FOMC decision. The US growth has actually exceeded expectation. Absolutely strong growth. Private consumption is robust, And therefore, instead of hard landing, which we talked about probably 6 months ago, now we're all discussing soft landing. No one is discussing recession anymore. And therefore, the FOMC decided whatever it did. But my own expectation is that inflation is still not close to the target. And therefore, the Fed may possibly, I won't be surprised if a 25 basis point hike is seen in the November meeting. And I don't see I don't see the easing cycle starting anytime before the second quarter of 2020. Let me put it this way. So this is the background in which we need to discuss gold. The second factor I want to talk about is the dollar. Obviously, the bullish trend in the dollar is continuing. And my own expectation about the dollar index is 104 to 106 over the rest of the year, and possibly even into the first quarter of next year, with the possibility of it going to 107. US dollar will continue to enjoy kind of safe haven support, even if, of course, the debt ceiling issue were to flare up, or there will be the threat of government shutdown, which may give a very temporary boost to gold. But otherwise, I'm seeing both from a dollar perspective primarily and bond yield perspective, gold will continue to be under pressure because it is facing headwinds.
All right, so gold might just continue to be under pressure, but then Lakshmi, what about the debt market? Considering the volatility in the equity markets, somewhere we are not we are not able to sustain on the higher levels, and there's selling pressure coming on over there. How do you think the bond yield or the bond market has priced in all the triggers that Chandrasekhar sir also highlighted, and also considering the domestic triggers that we have, be it monsoon, be it crude prices or the interest rate cycle? What's on radar? How much has it already been priced in?
So, Kavita, firstly, the bond prices have priced in bulk of the positive news. And the positive news, obviously, we are all aware, is a very recent one that, the inclusion of Indian bonds into the JP Morgan index. So that's clearly a very big positive. But if you look at the negatives, look at the US yields, they are 4.5% plus. You look at crude oil prices from where they were to where they are now. Small easing, but nothing great to reckon with. And also, if you look at the FOMC narrative, which is the higher for longer, all of these global movements, including the commodity, which is the crude oil price movement, does not seem to have got factored into the bond yields yet. So while there is a solace and there is a good comfort that our domestic macro is clearly on the mend, we also need to keep in mind that monsoons in India are below normal. As we speak, it's roughly about 10% below normal. And August was practically a dry month. September has picked up a little bit. So I think all this put together means that incrementally from here for yields to slide lower looks very difficult. It is being capped at maybe 720-25 levels, largely because of the announcement of the index inclusion, which is still some time away. So I think the near-term global, I would say, headwinds are slightly going to be weighing in on the sentiments, which can obviously or could obviously prevent a significant rally from the current levels.
So keeping all the triggers in mind, Chandrasekhar sir, what's going to be the policy stance according to you? Do you think monsoon is going to be the focus?
Food inflation will be the focus of attention.
Sure.
After all, elections are nearing.
Exactly.
Both 2 or 3 large states plus the general election. And there is an outside chance that the general elections may be advanced to maybe November, maybe December. We don't know. All this is possible. Therefore, food inflation will certainly weigh on the Reserve RBI's monetary policy. My own sense is that high interest rate high inflation will certainly prevent any rate cut. That is very clear. There is a possibility of a rate hike in India to fight inflation. Primarily because I think I presented on your channel my Kharif crop outlook last week, if I recall correctly. The Kharif crops are not really looking good. And as Lakshmi mentioned, suboptimal rainfall. It has affected rice harvest, pulses, oil seeds, cotton, all that. And therefore, rural incomes are not going to grow. Rural incomes will probably stay where they have been. And therefore, I think the priority for the Reserve Bank and, of course, for the government of India is to fight inflation. And therefore, I don't see any chance for a reduction in interest rate. There is a possibility that interest rate may be marginally hike. Whether that hike or a pause will help fight inflation, I'm not sure. Primarily, again, because as Lakshmi said, crude oil, $93, $94, $95, and I'm quite bullish on crude oil. Brent can potentially touch and breach $100 a barrel because of the fundamentals are very tight. The energy market, the crude oil supply demand fundamentals are rather tight, and therefore, and there is a huge amount of speculative interest, speculative capital that's flowing into the crude oil derivatives market. All that is going to fan inflation across the country and across the world, in fact. And therefore, I think inflation will continue to be the bugbear of various governments and various central bankers.
Lakshmi, your take, also considering the fact that the festive season also has just begun almost, and people would need money, but here comes a sign of no relief on the EMI front, and also looking at the RBI stance, monsoon is definitely a mood spoiler, and then going ahead, inflation. What is your reading on it on the interest rate stand now?
So clearly, Kavita, it is going to be higher for longer. The rate cut scenario, which, quite a few of the optimists, especially looking at the US data, had called for, that seems to be on the back burner for now. And if the mother of all economies is going to follow higher for longer, our sense is that despite the fact that headline inflation in India is cooling off, one has to keep in mind the other party poopers, as I call it, which is the fuel prices or monsoon potentially stoking up pulses and rice prices, etc. So one cannot be not mindful of that. So I think the yield curve is likely to remain elevated for some more time. Rate hike may not be immediately on the cards, but I think a hawkish undertone, given that global factors are dominating the scenario right now, could well be the order of the day. Outer chance, we don't know if things go completely awry, then I think those options, because US is not done away with its upward movement stance yet. They have taken a pause, no doubt. Is it a longish pause or the intermittent pause they took about 3 months back? I think that is going to be extremely data dependent. So the yield curve in India, if you see, is on a flattish terrain. Usually it's upward sloping. So looks like this flat yield curve is likely to stay at the elevated level for some more time.
Sure. All right, let's talk about the action part now. Chandrashekhar sir, time to initiate strategy in gold, maybe for short term or medium term. Is it possible? Gold and
Yes.
crude, in fact, because you're bullish on crude as well.
Yes. So things on gold, as I said, gold is most likely to be under pressure. It's facing a lot of headwinds, primarily as dollar strength, rising bond yields, and more importantly, which most analysts ignore, the physical market, physical demand. China is slowing down. In India, incomes are not rising to the extent they are expected to rise. And therefore, and gold prices have now reached a level where there will be consumer resistance. And that is a biting point. Anything above 55,000 rupees for 10 grams in India is going to actually destroy a part of the demand. And therefore, gold prices globally are going to be under pressure. They will obviously be under pressure in India because we simply reflect the global trends. We are price takers and we are not price setters. And therefore, the suggestion would be that as and when gold prices start to dip, investors can actually buy gold, but with the intention of keeping it for at least 3 quarters. I see gold prices crossing $2,000 an ounce in the international market. Certainly not even in the first quarter of next year, possibly in the second quarter or even later. And therefore, if one must have the appetite and the risk-taking ability to invest in gold today, buy it every dip, but wait for at least 6 months, if not 9 months, so that you are able to benefit from the rise in prices, which will happen certainly after the first quarter, maybe potentially even after the second quarter of next year. Number one. Number two, I don't know if I mentioned earlier, I'm expecting a 25 basis point rate hike from the US Fed, hopefully in November. And there are experts talking about one more rate hike, possibly in the first quarter of next year. All this is going to put is going to lend strength to the dollar and is going to put gold under pressure. And therefore, gold can potentially fall below $1,900 an ounce, and that will be, in my view, a good buying opportunity. And if you want me to talk about crude oil,
yeah,
crude oil,
yeah, please
I'm bullish.
go on.
Yeah, I'm bullish. The supply-demand fundamentals are quite tight. Both the International Energy Agency and OPEC, both of them have admitted and both of them have announced that there'll be about 1.5 million barrels a day short supply, certainly in the last quarter of this year. Next year may be different, but at least till the end of this year, there will be very tight supplies and there could potentially be a shortfall in supplies, and which will lend and is already starting to do that. Prices have risen, and this is the opportunity speculative investors have been waiting for. There's a huge amount of speculative interest now in crude oil, which is propping the prices up, and it can potentially go touch $100 and go beyond that, which is going to be highly inflationary for all the economies, and certainly as far as our country is concerned. Yeah.
Sure. Chandrasekhar sir, I'm going to come back to you because viewers have to know that you also have a Brahmastra strategy, and that's called 3-in-1 strategy. Across asset classes, how can you initiate trades and calls? So I will go to Lakshmi and ask question on fixed income, but then I'm going to come back to you for the 3-in-1 strategy. So please get ready with the Brahmastra. So Lakshmi, coming to you, the word is to go short term now in as far as debt is concerned or fixed income is concerned. Do we see more raise in fixed deposit interest rate also?
The term deposit rates, or for that matter, the market rates in fixed income are already at elevated levels, Kavita. It is very unlikely that you are going to see these yields ease in a very big hurry. So whether you are a term deposit investor or a fixed income investor investing in bonds in the market, I think these opportunities are available for you to make your deployments at the current levels. At the same time, we need to be mindful that the overall banking system liquidity is still reasonably tight, and that's not going to resolve anytime really soon. So these rates are here to stay for a bit and unfold gradually. As I mentioned, if in a chance that foreign investors start upfronting or front loading their allocations to India, which probably may not happen before January of 2024, because we hardly have 3 more months to go before the calendar year gets over. A small bit of trickle flows can come in, but I think investors can make use of this opportunity to probably take investment positions in around the 3 to 5 year kind of duration bucket, where the yields look fairly lucrative.
Sure. All right. So my time is literally up. My producer and director are asking me to end the discussion, but then I cannot do that without asking you your Brahmastra 3-in-1 strategy. Chandrasekhar sir.
Yeah, bilkul. Dollar, I'm bullish on the dollar. I think one should
Okay.
go long on the dollar for at least the
Okay.
next 3 months, and one could go short on gold at least over the next 3 months. That is till at the end of the year, and one can go long on crude oil. But what is important is the market is going to be volatile. There will be corrections. US's debt ceiling is an issue which can, for a temporary period, boost gold prices. So one has to be very alert, very alive to market dynamics, and be able to read market signals well in advance.
All right. So that's the word coming in on gold, crude, dollar, and debt investment. Thank you so much, Lakshmi and Chandrasekhar sir, for being on the show and helping our viewers today with this. Thank you so much.
God bless. Yep.
All right, time to slip into a short break, but then post that, I'll be joined by Shweta Rajani from Anand Rathi to answer all of your mutual fund portfolio queries. Welcome back. You're watching The Money Show with me, Kavita Thaplial, and last leg of the show where we answer your mutual fund portfolio queries. I'm joined by Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Shweta, good evening. Welcome to the show. Let's move on to our first viewer. I have Aditya from Chennai online with me. Hi, Aditya. Good evening. How are you doing?
Hi, I'm fine. Am I audible?
Thank you so. Yeah, you are audible, and thank you so much for sending us your question. I believe you have been investing in ELSS and now you want to move out of your ELSS funds and maybe have a more active or passive strategy in your portfolio. Is that right?
Yes. See, I mean, over a period of last 20 years and all, I've been investing. So,
Okay.
on tax saving basis and all, I've done in, say, 6 or 7 ELSS. By this time, it got accumulated and all, some decent amount.
Okay.
So now I want to move on to the, indexing funding, because I have other schemes also where it will take care of all other segments, market like flexi cap, mid cap, small cap and all. So now I don't have any index fund in my portfolio. So I'm thinking, can I shift all this funds?
Are you sure you really need an index fund in your portfolio? Because the current portfolio is very well diversified. Just for adding one more aspect of diversification, you want an index fund, or you really see the need to have an index fund in your portfolio?
Because it's more on tilted towards large cap as such. Okay, with small cap being, small cap is as per my age and all, I can stay invested for another 10-15 years. So I've invested 20% of my portfolio into small cap also. So, I'm not
just
sure
for large cap exposure, you are looking at an index strategy, a passive strategy.
Exactly.
Is that right?
And more importantly, yes. And more importantly, I got like 7 or 8 schemes in ELSS, and not that easy to track it. And most of the cases, like a couple of them at least, are not performing well. So,
Got it.
I'm on like that, whether to do it or not.
Got it.
That's a query.
Okay, got it. Okay. All right. Shweta, over to you. 6 to 7 ELSS funds he has in his portfolio and not happy with the performance, but then, he wants to have a passive exposure as far as the large cap is concerned.
Yes. Aditya, I was listening to your query, and my honest opinion would be that for a large cap exposure, you don't necessarily need to have an index fund. Let me give you some data here. If I look at active funds versus passive fund performance for the last 23 years, almost 67% of the active funds would have beaten Nifty 50. If I just look at the last 5 years and specifically look at the large cap fund universe, almost 40% of the large cap funds beat their benchmark, and the average alpha or the outperformance to the index that they deliver has been around 3% per annum. This data clearly substantiates the point of not having the need to take an index fund right now in the portfolio. Even if you want a large cap exposure, go in for a large cap fund. Even better would be you take that exposure through a flexi cap or a large and mid cap fund. Even a flexi cap fund tends to invest almost 70 to 75% of their money in the large cap stocks, which are the top 100 stocks. So, my recommendation to you would be index fund can be avoided. More specifically in India, for the next 5-10 years, you can stay away from an index and be in the active space and benefit from that extra return or that alpha, as we call it, for your portfolio. Some funds you can consider here would be an HDFC Flexi Cap or a DSP Equity Opportunities. I'm not suggesting other categories because you said you already have a small cap exposure. Also, on your small cap exposure, you have 20%. Given the current market scenario, you can have 20 to 30% small cap exposure. That will actually help you enhance the return on your portfolio. So net, it's okay if you don't have an index fund, redeem your ELSS, shift to a flexi or a large and mid cap category.
Great. Aditya, is there anything else you want to ask Shweta?
No, thank you. Thanks a lot. Thank you.
All the best, Aditya. We move on and let's take Ghanshyam's question from Surat. Shweta, he wants to do an SIP of 6,000 and he wants to know the name of funds.
Super. Ghanshyam, one thing is good that you've chosen to go in for an SIP. Now, this will bring in the investment discipline in you. It will also help you get the benefit of compounding that we all talk about. I'm guessing you're still starting off. You've not shared your portfolio. So what I would suggest is, 6 funds to you so that you get the benefit of different categories, different styles in your portfolio. 2 funds, IPRU Dividend Yield, SBI Contra. They add in a different style of investing. You can also go in for a small cap fund in the portfolio, right? So you can take in for an Invesco small cap or an HDFC small cap in the portfolio, go in for a flexi cap fund, HDFC flexi cap, go in for a multi-cap fund, a Kotak multi-cap or a Quant Active. These are few funds you can consider. Like I said, it will give you benefit of investing across the market cap, large, mid, small, some different styles also coming in, like a dividend yield or a contra to the portfolio.
Quickly, Shweta, last question. We'll take Adarsh's question. He wants to accumulate 50 lakhs in 10 years. And what should be the ideal SIP amount and funds for his goals?
Adarsh, one thing is good. You've laid out your goal pretty clearly that you want to look at 50 lakhs in the next 10 years. There are 2 options or 2 ways through which you can actually achieve that. One is you start with a SIP of 20,000 per month, and that will take you to your goal of 50 lakhs. Or you can start off with an SIP of 15,000 per month, step it up. So there's something called as a step up SIP, which means that you can go in for a 10% step up. That means every year 10% of your SIP amount increases. So if it's 15,000 today, next year it will be 16,500. The year after that, another 17,000 odd amount will go in as an SIP. So those are your 2 alternatives. Looking at the historical growth rate of equity, and I'm assuming this will entirely go into equity, you can expect a 14% kind of a return. Some funds that you can consider here, a Canada Robeco Flexi Cap, a Quant Active Fund, a Kotak Multi-Cap Fund, go in for an SBI Large and Mid and Invesco Small. So you'll again get diversification and you will get the advantage of unique styles coming into play for your portfolio's benefit.
All right, with that, time is up. Thank you so much, Shweta, for being on the show today and giving your valuable advice to our viewers. Thank you so much.
Thank you.
And it's time up on the Money Show as well, but I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. Thank you so much for watching. Goodbye.